In this video, I'm going to walk through the preparation of the master budget. Just as a reminder, in the previous video, I went through all the assumptions. If you have not walked through that video or watched that video, I strongly suggest you do that before you watch this one. So I'm going to move from the assumption page to the supporting schedule page. On this page, we prepare the schedules that are going to basically feed into our final products, i.e. the cash budget, the income statement, and the balance sheet. So the first thing I want to do is I want to come up with monthly collections. We have the budget for the monthly sales, but as we talked about in our assumptions, we're not collecting everything at point of sales, so cash collections may vary each month from what the sales were. So you'll remember from the assumptions that we're assuming 20% cash sales collected in the month of sale, 80% credit sales, and those will be collected in the month following sale. So for April, we've got $14,000 in cash sales, which is simply the April sales of $70,000 times the 20%. Then credit sales for April will, of course, be based on March sales. There are a couple of ways we can get at this number. One is we can take March sales, which were given, times the 80%, and that gives us 48,000. However, you can also look at our balance sheet from March 31st, and you'll see 48,000 in accounts receivable. If we're assuming in this example that everything that is sold on credit will be collected the following month, then we can basically assume that the accounts receivable at the end of one month becomes our collections during the next month. So let's look at May. Cash sales are going to be calculated by taking 20% of May sales, and credit sales calculated at 80% of April sales, for a total of $73,000 in sales for the month of May. Then June, we'll go through the same calculation. 20% of June sales are the cash collections, 80% of May sales are the credit collections, and we have $86,000 in cash collections for the month of June. So these numbers we will need for our cash budget when we prepare that in a few minutes. The next supporting schedule is our inventory purchases. You may remember from earlier in the quad or from financial accounting, the equation that we use to calculate cost of goods sold is beginning inventory plus purchases, which represents goods available for sale, minus our ending inventory equals our cost of goods sold. Well, we're basically going to use that equation, but with some of the items, parameters moved around. So for April, we're going to come up with budgeted cost of goods sold, and we get that by taking our April sales times the 60% that we are anticipating the goods to cost. In essence, cost of goods sold. So the assumption here is we know we need $42,000 worth of inventory just to make April sales. We'll do the same thing for May and take 60% times 85,000 to come up with 51,000. We know we have to have at least that much in acquisitions to cover the current month's sales. And then we'll do the same thing for June, 60% of 90,000 budgeted sales, or 54,000. But you'll remember from the assumptions that we also want to have some inventory on hand. In fact, what we want is 30% of the next month's sales. Now, notice this is inventory. We're looking at costs. So even though we're looking at 30% of the next month's sales, we want 30% of the cost of each month, the next month's sales. So what we've done is I've taken the 51,000 in May, multiplied that by the 30% desired ending inventory, and in essence, we want to have $15,300 worth of goods still in inventory at the end of April. So if we're going to cover our current month's sales and have our desired ending inventory, then we need $57,300 worth of inventory throughout the month. But we don't need to buy that amount. Why? Because if we go back to our balance sheet, we have at the end of March, beginning of April, $12,600 sitting in our inventory. So we can subtract that from our total needs and say, okay, we need to purchase during the month of April $44,700 worth of inventory. We'll do the same thing in May. We already have our budgeted cost of goods sold. 30% of June's sales is $16,200. We need then $67,200 worth of inventory. But at the end of April, beginning of May, we already have $15,300. So we only need to purchase $51,900. And then we go through the same calculation for June. Now, here is why in the assumptions I gave us budgeted sales for July, because we need to know what our sales are anticipated for July to know how much ending inventory we need at June. So I took the 50,000, this 30,000 right here is the 50,000 at 60, and then I took 30% of that. We need at the end of June to have $9,000 worth of inventory on hand. And then we'll subtract our ending May inventory, which is our beginning June inventory, and we need to purchase $46,800. Great. We now know how much inventory we need to purchase, but as we talked about in the assumptions, we aren't going to pay for it necessarily right when we purchase it. So we need a cash payment or cash disbursement schedule. And so if we go back to the assumptions, our assumptions were 50-50, 50 paid in the current month, 50 paid in the following month. So April current month purchases is just half of the 44,700. And then the prior month's purchases, we can actually again go back to our balance sheet. And if we assume accounts payable is all going to be paid off the next month, then that becomes our prior month's purchases. And we need to plan that we will need $40,650 in cash. Then for May, current month, we'll take half of the current month purchases. Prior month, we'll take half of April, which is effectively the same as our April current month purchases. And then we'll do the same thing for June. And we now have our cash needs to meet those purchase requirements. And then lastly, for our supporting schedule, we have a schedule of cash disbursements for operating expenses. These come straight from this last item number 6 on our assumption page. You'll notice salaries and wages and advertising are both fixed expenses, so they're the same each month. Shipping was a function of sales at 6%, so each month is just 6% of the sales, and other expenses was 4% of sales, so that calculation is 4% of sales. And then just sum the total. Notice what's not there. If you go back to the assumption page, included in the operating expenses is depreciation. You do not see depreciation in this. Think about why. See if you can think about why we would not include depreciation in this schedule of cash disbursements. If your answer was it's because we know that depreciation is a non-cash expense, you're absolutely right. Remember, depreciation is an allocation of the original cost of whatever it is we're depreciating. So it does not use cash, and effectively what this schedule is just a schedule of cash requirements for operating expenses. Okay, so I think we have all our supporting documents. Let's now move over to the cash budget and walk through the preparation of that. Notice it is on a monthly basis. That's because if there is a month wherein we do not have enough cash, we need to be aware of that so that we can make appropriate plans. And by the same token, if there's a month that we have excess cash, we need to think about what we want to do with it that is a good investment. So for April, we're going to start with beginning cash, which we get straight off our balance sheet at March 31. Then we'll add our cash collections, which comes straight from our supporting schedules, the cash collection schedule. That gives us total cash available of $71,000. Then we need to offset against that our cash disbursements. For inventory, that comes from our supporting schedule. Make sure you pick up the right number. This is our cash budget, so we want the cash disbursement, not the purchases. So it'll be the $40,650. Then our operating expenses will come from our schedule of cash disbursements for operating expenses, $20,500. And then remember, we had originally planned in our assumptions that we would acquire some equipment in April to the tune of $11,500. So that is coming out. That's a total disbursement of $72,650. That leaves us with a deficiency of cash of $1,650. Now, remember, from the assumption page, we have a minimum required cash balance of $8,000, but we can borrow only in increments of $1,000. Well, we need to cover that negative $1,650 plus $8,000. That would be a total of $9,650. That means we have to honor the $1,000 increments. We need to round up to $10,000. That leaves us with ending cash of $8,350. For May, we're going to walk through the same scenario, really. The beginning cash for May is what we end April with. The cash collections come from the supporting schedule page. We now have $81,350 in total cash available. The inventory disbursements and operating expense disbursements also will come from our supporting schedule page. If you go back to the assumptions, we had another equipment purchase planned for May to the tune of $3,000. That's a total disbursement of $73,300, which leaves us with an excess of cash of $8,050. Now, note, we have our minimum cash balance, but do we have enough to pay any of that previous borrowing back? And the answer is no. So there will be no activity in the financing section. Then for June, beginning cash is what we end May with. We had cash collections of $86,000 for total cash of $94,050. Inventory disbursements, operating expense disbursements. There were no more equipment purchases planned. So we have total disbursements of $71,850. That leaves us with excess cash of $22,200. Now we have more than enough cash to pay back the full $10,000 we borrowed in April. And remember, we had an 8% interest Notice the interest. What I've done here for simplicity's sake is I assumed we borrowed at the beginning of April and we paid back at the end of June. So we're going to assume we pay a full 3 months worth of interest. So the interest calculation is that 8% interest times the $10,000 we borrowed. Remember, interest rates are annual, so we would prorate that for 3 out of 12 months. And that's $200 in interest, leaving us with $12,000 in cash at the end of the quarter. And then we just have quarter totals over on the right. Okay. Now, a quick question. We had to borrow $10,000. Think about, is there a way that we might be able to change some of our numbers so that we didn't have to borrow anything? I know one thing I would do, if you look at this, if it weren't for this $11,500 in equipment that we bought in April, we would have been fine. So I might consider going back to whoever requested that equipment purchase and find out if it was absolutely needed in April or if it could be deferred to June. Because June, we're racking in the cash. If we could defer the equipment purchase till June, we wouldn't have to borrow any money. Now, it may be that the equipment is urgent, is critical to what we're going to be needing to do in April and May, and that may not be feasible. But those are the types of things, as you put together your budget and you see the outcome, you want to take a look at and see what you might be able to do to create a better budget for the company. All right, let's run through the income statement and the balance sheet. The income statement, our sales come straight from the assumption page. It's just a sum of April, May, and June sales. Beginning inventory came from the balance sheet, so we're calculating cost of goods sold. Beginning inventory came from the balance sheet from March 31. The purchases came from our supporting schedule. Right here, the 143.4. Goods, and that goods available for sale is just the sum of those two. We subtract out our ending inventory, which is also from the supporting schedule page. It's right there. And that gives us our cost of goods sold. Gross margin is just the difference between sales and cost of goods sold. Our cash operating expenses come from the supporting schedules, the total. And then notice, now we're going to include depreciation. Depreciation doesn't affect cash, but it most certainly affects income. And that's going to leave us with $71,000 in total operating expenses. We subtract that from our gross margin, and that gives us our net operating income of $27,000. Then we had that interest expense, so we pull that over from our cash budget, and we are left with $26,800 in budgeted net income. Okay. So as you can see, once you prepare those supporting schedules, really it's just a matter of everything feeding into the income statement that needs to. Lastly, let's look at the balance sheet. Cash, well, that came from our cash budget, the $12,000 we ended with. Accounts receivable is a function of June sales. Remember that anything that isn't the credit sales we make in 1 month, we're assuming will be collected the next month. So if we take the 80% of credit sales and multiply it by June sales, that should be our accounts receivable at the end of June. Inventory, we already talked about. Buildings and equipment. This is just a function of what we ended March with, which was $214,100, plus our acquisitions in April and May, and then minus our depreciation. And that gives us $222,600. Total assets then is just the sum of that. Now, on the liability and equity side, accounts payable is just a function of what we acquired on credit. And you'll remember that was 50% of our purchases for the month of June. And capital stock, we had no activity, so that comes straight off the March 31 balance sheet. Retained earnings. Think about what causes retained earnings to change. If you remember from financial accounting, two things cause retained earnings to change. Net income and dividends. In this case, we did not have any assumptions related to the payment of dividends. So in reality, the only thing that changed retained earnings was the net income. So my equation here, you'll notice, is the retained earnings from March 31 plus the net income from our income statement. And then the sum of that, $315,600, which means our total liabilities and stockholders' equity equal our total assets. And all is good.